Shah, Deputy Managing Director with the Mahindra Group, to talk about where the Mahindra Group feels the recovery is back, and more importantly, where recovery is here to stay. Would they be looking at investing, and how are they really looking at really converting this scenario into better profitability for the shareholders? Mr. Shah, always a pleasure to have you back. Thank you for joining us. Now, Mr. Shah, when we spoke last time, it was before the festival season. And that time your view was things were looking stable and you were quite upbeat. We are speaking to you now post the festival season. So would you say that whatever uptick we've seen in and around festival season is not only back, but it is here to stay?
Good morning. First, it's a pleasure to be here. And yes, we are seeing a lot more demand than we saw pre-festive season. The festive season obviously was excellent. We had a very significant growth in both tractor and auto. And in both areas, we are seeing, in some sense, the inability to meet the demand. The biggest positive is that urban markets are now showing very high demand, which was not the case earlier. And that augurs well for the future.
Could you walk us through that what is fueling your optimism? Is it largely because of inventory levels are coming back, or you think low interest rates have played a very large role in the segments which you represent, autos?
Inventory levels are not quite back to where we want it as yet, which in a sense is a good problem because we've been able to sell a lot more than what we had expected. We are producing at close to 100% capacity in tractors, between 85 and 100 in auto, and still not fully able to meet the demand. So demand has been extremely strong, and we expect over the next month or two for inventory levels to start building up and getting back to what is normal. So overall, we feel very positive about where we are today. What we do see is some supply chain constraints coming up, especially in auto, in regard to electronics. There's a global demand for chips at a much higher level than has been in the past. And we are seeing all automakers face that. So that's one of the constraints that we will have to work through.
Demand has come back, but prices have also gone higher. Steel prices, raw material prices. So are we in a situation where top line is great, but at the EBITDA level, the optimism may not be captured?
Too early to say on that. Our results that we declared for the second quarter had the highest ever operating margins for tractors. And both for auto and tractors, we were the highest in the industry. So at this point in time, it remains to be seen how much of the increase in commodity prices can be passed on in terms of overall pricing. And that's something that we will have to look at. But going back to your earlier question as well, what's fueling this demand? It is essentially driven by a number of factors. In rural markets, it's been driven by monsoons, a very strong production or farm produce in rural areas for both the Kharif and Rabi crops, and reservoir levels. That combined with some optimism we see there for the future with regard to reforms. I know that's a tricky topic, and there are a number of issues around that as well. But there are some positives to that, and that's really fueling the rural demand. Urban is in all senses a pent-up demand that's really coming back now.
Okay, so when we met earlier, we were using the pre-COVID levels as the high watermark level to understand your outlook. Let me take the opportunity of extending the timeline to 2018, because 2018 is when the slowdown in the auto sector has started. When do you think for your non-farm business you will be able to go back to your 2018 levels?
I would say in the next 6 months or so.
That's a one-word answer, but it carries a lot of weight. What you are confirming to us and to your shareholders on a ET Now forum is that Mahindra & Mahindra is confident that the auto business and this is the non-auto business, will go back to 2018 levels of peak auto demand in next 6 months?
If all goes well. Right? The question is, what are other issues that will hit us? That's unknown. But in terms of the demand side, what we are seeing right now is things are stabilizing well. And we expect the demand to continue at that levels. The question in auto is essentially going to be around supply chain constraints, the electronics part I talked about earlier. But if that can be resolved, then we do see demand going back to the 18 levels in about 6 months or so.
Okay, let's spend some time to understand that what are the plans for the auto business, and I'm again talking about the non-farm business. There has been a new launch Thar. I understand that it is a great success. But barring that, how many new launches are planned in next 12 months? I also understand that you are looking at perhaps coming out with new platforms for even a Scorpio and XUV 500.
That's right. So we will come up with a new platform for Scorpio. The XUV 500 is essentially going to be replaced by a completely new car. And both are in the core segment that we play in. So we are very excited about both of these launches. And then we will have a third launch coming up in about 18 months' time as well.
When will new models from the Ford joint venture start hitting the market?
That will still take about 2.5 to 3.5 years. So there is more time on that horizon. So we're in the process of essentially the early stages there. So we would look at a 2.5 to 3.5 year time frame for the first new model to come in.
The SUV market, Mr. Shah, has been a very interesting market. You almost had a market leadership till about a couple of years ago, then competition intensified, and then price war started. What is your outlook for the SUV market going forward, considering that premiumization has happened in that category, and because of low interest rates and because of desire of owning strong cars, that is one segment where the growth, some would argue, would be higher than the normal car industry?
So the SUV segment has been growing much faster than the normal car industry. We've seen a little bit of slowdown in growth overall over the last couple of years, but we see that going back much stronger now. And for us, our core segment is really the larger, the tough and rugged SUVs. We ventured out of the core to some extent, but we're getting back to our core now. And we see demand for that actually growing faster than any other segment.
How is the company planning to leverage their dominant franchise in the farm equipment business, especially the tractor business? You have an enviable share of 40%, but knowing your DNA, you will not be satisfied at 40%. Are you looking at a strategy to increase more market share?
For us, profitable growth is important. So it's a combination of market share growth and profit at the same time. But the big opportunity in farm is around farm implements. That's a nascent market in India today. If you look at this globally, implements are 2x the global tractor market. In India, they're less than 5%. And that's where the real opportunity for growth is.
And how exactly are you planning to expand your farm equipment business, let's say the non-tractor part? Because you have a brand, you have a distribution. Could we be looking at a substantial change in terms of that category, where rather than only focusing on tractors, you're essentially looking at increasing the total market space by increasing the offerings and by increasing the breadth?
Yes. So in addition to tractors, implements is a key part. And what we are also focused on right now is what we call Krishi, which is using technology to enhance productivity for farmers. So using AI, using IoT, connecting them with our tractors and implements, and demonstrating to farmers that this generates much greater productivity, essentially being able to create a plan for each farm that's customized based on the soil in that plant, at that farm, that's customized based on the conditions in the ground, that fertilizers that have been used in the past, And that customization will help drive that productivity. So that's really a key part of the farm business now, and one that will grow at the same time, help create more value for farmers, and in that sense, enhance farm incomes.
You've been making a point that the group now would be very conscious about capital allocation. And what we understand is that you are looking at it, perhaps dividing the group companies into three buckets. And the buckets essentially would be centered around profitability, it would be driven around potential growth and strategic fit. Would you like to walk us through your thought process here, that which company falls into which bucket?
So on this front, we had seen various challenges with our international subsidiaries. So we really focused on that first to say that we have to fix it. We said category A was a path to 18% ROE in 3 to 5 years. Category B was a strong but quantifiable strategic benefit that gets us to the same returns. And category C was neither of the above. SsangYong fell into category C, and which is where the first action we took was for a board to announce that we will not be investing anymore in SsangYong. We've gone through a number of businesses since then. Gen Z we have shut down. We had our first choice services business. This is specifically the business for servicing used cars, not for the used car sale platform, which is a business we love, incidentally. So the servicing business was sold to TVS. There were other areas where we did not invest further. We shut down the aircraft business because it fell into category C. And there are a few businesses we are now evaluating, but what we've seen over the last couple of quarters also is a significant turnaround in our international subsidiaries, especially on the farm side. So we feel much better about that. And we are in the process of completing our evaluation, setting milestones for those businesses. And we feel that many of them will be in category A or B. But that final confirmation we will give once that evaluation is completed.
So what is the long-term objective in terms of a return ratio which you would like to achieve?
The long-term objective is to have returns greater than 18%. I've talked earlier about the 17-year run that we've had from 2002 to 2018, where we were the best performing stock in the Nifty. That was driven by EPS growth of 22%, ROE of 18%, and strong free cash flow. So those are the three metrics we have to drive again, with the hope of setting up another 17-year or higher run.
Okay. Is SsangYong your single biggest pain point, which is now over in terms of a size, in terms of a commitment, in terms of a commitment, and the other, other allocations, do you think may not be that large? I'm simply trying to understand that what you've done with SsangYong, was that the biggest challenge which you had, and the other challenges are very small?
That was by far the biggest. So as we looked at numbers for fiscal 20, 80% of our challenge, or 80% of the losses were driven by SsangYong and Gen Z. And those are both businesses that we have addressed at this point in time. And there are smaller issues as well, but I talked about how we are addressing them, either turning them around, getting them back on a path to profitability, or in some cases exiting them. So we feel pretty good about where we are today.
Okay, EV, something which we always discuss and we have to discuss. If I look at Tesla's market cap, the fact that Mr. Musk is the second richest man on the planet now, it just tells you that markets are saying that a large disruption in the auto space is coming. But for Mahindra and Mahindra, there is one, it is going to be a very interesting and a challenging time. One side you're focusing on return ratios, and on the other side you're also investing in the electric business. Can they both coexist? Because if you're return conscious, you cannot invest a lot in your electric business, because that's going to be return dilutive at least for next couple of years.
It will depend on how the EV story plays out. And here's the roadmap that we see. There are three phases to this. The first phase is last mile, which is essentially three-wheelers and smaller four-wheelers for both passenger and cargo. That market is here today. We have a very good set of products there. We are a market leader in that space, and we see that space really replacing all of the ICE engines that have been there. So that will start now. and we see strong returns coming on the investments we made there already. The second phase, which also is concurrent in a sense, is for electrification of fleets. We don't see cost parity there as yet, though we're fairly close to it. This is electrifying existing cars and putting them out for Ola, Uber, and various other fleets that are out there. That's, in a sense, going to be a shorter-term market because that will be replaced by a born electric platform. And that is a third phase, which we will get born electric cars in India. The third phase we see in about 3 to 5 years. So while investments will take some time to generate returns, we are still fairly confident about being able to maintain the levels that we've talked about, because as we invest more in EV, over time, investment in ICE engines will go down. And overall, we're looking at a lower capex spend, given the platforms we have built already over the next 3 years, despite greater investments in EV. So on balance, we feel good about the returns that we would see in the auto business and the farm business.
Could you broadly tell us that how much capex are you planning for your traditional auto business and how much investment are you planning for your EV business?
The capex for auto overall is 9,000 crores over the next 3 years. That includes EV. We don't have an exact split between EV and the rest of auto as yet, because that will depend on how we see the EV industry playing out and the growth that will be driven. Now, let me talk about what will drive the growth in EV. It's going to be cost parity to start with, because while there will be some early adopters, most others would want to buy a car at the same price and may not want to pay more for an EV. Some may look at the total cost of ownership, which will help. The second factor there is range anxiety and the ability to charge quickly. And the third factor is essentially the ability to have infrastructure for that charging. So those are the three drivers. And if those three drivers can come in faster, we will spend more on EV of the 9,000 crores. If it's going to take a little longer, then we may spend less on that initially.
But in your assumption, Mr. Shah, do you think the EV disruption is real, or in India we are too early to start talking about it?
The EV disruption is real, and I would say that EVs are here to stay. The question is when. In India, given that incentives for EVs are lower than some of the markets that we see around the world, it will take a little longer for EV penetration. And therefore, in our view, it's just a question of when. By 2025, we see EVs starting to come in at a reasonable pace. And by 2030, we see that EVs will be here to stay and will be a majority of the market, in terms of new cars at least.
How prepared are your other subsidiary companies like Mahindra CIE, Mahindra Eugene to adapt to this disruption?
So Mahindra CIE is really not a subsidiary company anymore. It's an investment we have. We have a fairly low stake in that. So that's one that we don't manage anymore. CIE manages that. Similar with all our component businesses have really been put into CIE. So we don't have exposure to auto components anymore.
Okay, fair point. In this decade, which is the current decade, which are the three businesses which you have incubated you think are likely to become big?
But used cars. I mentioned that briefly earlier. This is a business which is much larger than new cars. If you look at the last year, 4.2 million used cars were sold versus 2.5 million new cars. The used car market has largely been unorganized. And it's a very, very complex one as well, because it requires a number of physical assets, as well as in today's world, a number of digital assets. We've taken a very capital conscious approach, but a very sound approach in terms of building that business, because we felt that the physical assets were important. So what we built in terms of inspections, in terms of number of yards, we have 850 yards out there. We're the largest company in terms of inspections. We've got 1,000 plus franchisees on the ground as well. So that has been the first step taken in building that business. The next step is looking at the digital presence and being able to reach out to customers, where we are not as strong as many of our competitors in that space. But as we build that, we feel that we will have a powerhouse in our used car business. And that's going to be one of the biggest businesses that we would take forward. Second, I would talk about rural housing finance. This is a market that is, again, largely untapped. We have a fairly unique model with the strength of Mahindra Finance. This is a business that can grow significantly. Today, it is earning a fair degree of profit. Its cash generation is fairly strong. And this is one of the businesses that we would see coming into IPO much faster. And the third one I would look at is logistics, which is a public entity right now for us. But logistics has just tremendous potential in India. And the growth in that business can be very significant. So those are three I would look at as strong growth entities. But there are many others as well. We've talked about the 10 gems. And we feel pretty good about many of those businesses becoming bigger over time.
Well, we wish you all the best. Happy to share with our viewers, the stock is at 700 plus. So it's now within marching distance from an all-time high, which by the way touched a couple of days ago only. Appreciate your time, Mr. Shah. Thank you so very much for joining us. All right, let's take a break. When we come back, Sanjeev Chandanian, lots to discuss and understand from him. What's happening to the digital world, which way startups are moving, what has happened to the startup world in the post-pandemic world, and where exactly is he allocating. Look, one thing about Info Edge and Sanjeev's team has been the ability to invest in startups and still maintaining a lot of cash on their balance sheet. I mean, he has a very deep understanding of how to invest and how to maintain capital discipline. How has he managed to create this magic of investing and also maintaining capital discipline? Much more on that on this special chat right after this break.